Welcome back to the Neuro Finance Masterclass. Today, on day 11, 117, we mastered the favorite indicator of growth stock predators. I'm Ibrahim, and my co-host and I are absolutely fired up to guide you through phase 2 of your 365 days to financial freedom.
That's right, Ibrahim. Yesterday, on day 116, we really locked down the mechanics of floating supply destruction with share buybacks. But today we're giving your cognitive software a massive upgrade. This explainer is all about pricing the velocity of growth. We're basically stepping right back onto the trading floor to fix the absolute biggest limitation of classical valuation. We are leaving the static behind and diving headfirst into the dynamic.
As the architect always says, a multiple without velocity is meaningless. So, what does this actually mean for us? Well, we call it the static multiplier trap. Think back to day 88 when we first broke down the traditional PE ratio. What usually happens to an amateur investor? They learn what a PE ratio is, and suddenly they get totally financially rigid. They see an aggressive, cutting-edge AI company trading at a PE of 35, they literally panic, and they run away screaming, "Oh no, it's a bubble!"
Exactly. And we see it happen every single cycle. They get completely trapped by this one static number. And then, you know what happens? They sit on the sidelines and just painfully watch that exact same stock compound 500% over the next 3 years. The amateur completely misses out on that explosive move because they just don't get that a multiple without velocity is meaningless. So today, we're curing that rigidity. Today, we master the PEG ratio.
All right, let's jump right into the math. Section 1, the mathematical formula. Pricing the velocity. So this was famously popularized by Wall Street legend Peter Lynch. The PEG ratio is essentially the bridge connecting a static valuation to raw future velocity. We're moving away from just looking at a static price tag and looking at the pure acceleration of the business itself. The PEG ratio is just a company's traditional PE ratio divided by its annual expected earnings growth rate, expressed as a whole number percentage. It connects the snapshot of a company's current valuation straight to the raw velocity of its future earnings. We're not operating in a vacuum anymore.
Right. And the absolutely crucial point here is that this simple division forces you to trade acceleration, not just static numbers. It demands that a stock actually justifies its premium price tag with a massive, explosive earnings growth engine. If a company wants to trade at a high multiple, well, this formula makes them prove they actually have the velocity to back it up.
Let's look at a really stark mathematical contrast to put this into perspective. Say we have company A, which is a pretty stagnant business. It has a PE of 20, and it's growing its earnings at just 10% a year. So 20 divided by 10 gives us a PEG of 2.0. Now compare that to company B. This is a hyper-efficient tech monopoly. Its PE is 30. Now amateurs see that 30 and immediately think, no way, that's way too expensive. But wait, it's growing its earnings at 30% per year. So 30 divided by 30 gives us a PEG of exactly 1.0. And this right here is a real game changer for your portfolio. On a standard unadjusted PE basis, company A looks cheaper at 20 versus 30. But on a growth-adjusted basis, company B is so much more attractive. A PE of 30 looks incredibly expensive for a stagnant steel mill, but it is dirt cheap for a tech company growing at 30 or 40% a year. You aren't trading static numbers anymore. You are trading pure acceleration. Okay, moving right along to section 2, the architect's growth grid, reading the boundaries. To truly hardwire this PEG method into your core neurofitness, just knowing the formula isn't enough. You have to apply strict mathematical boundaries to your decisions. Think back to day 103 with our sector Akron audits. You need a highly quantitative framework, a grid, to instantly filter out all that market noise. First up, a PEG ratio below 1.0. This is the undervalued growth lane. It's the ultimate sweet spot. It means the company's growth velocity is just completely outstripping its price tag. The market hasn't fully priced in that explosive compounding engine yet. This right here is where asymmetric wealth is secured. Undervalued hypergrowth. Then you hit the benchmark of a PEG exactly at 1.0. This is your fair value floor. The price is perfectly in sync with the growth rate, meaning the market is pricing the operational model completely rationally. But, and this is a big but, you must be hypervigilant when you see a PEG above 2.0. We call this the narrative overexpansion zone. High danger. The stock price is completely decoupled from its actual earnings velocity. The multiple is running on pure crowd hype and unrealistic future expectations. If you buy into that zone, you are incredibly vulnerable to a severe multiple contraction. Which brings us to section 3, tech versus commodity filter, the absolute equalizer. Abraham uses the PEG ratio to navigate cross-sector allocations safely. It really is the absolute equalizer. We talked about capital-heavy, low-growth sectors back on day 113. Those sectors are physically bound. They literally cannot sustain high PE ratios because their growth is held back by massive physical constraints. You simply can't value a capital-intensive pipeline business the same way you'd value an infinitely scalable software platform. The physical limits dictate the absolute growth ceiling, and so they have to dictate the multiple.
And applying a brutal quantitative filter shows this instantly. A supposedly safe utility company with a PE of 25 and a sluggish 5% growth rate, that yields a highly toxic PEG of 5.0. It is a massive overvalued trap just wrapped in this illusion of safety. On the flip side, an asset-light biotech matrix or a sleek software firm might command a PE of 40. That totally terrifies the amateur. But if its internal operational leverage is expanding earnings at a blistering 45% annually, its PEG is just 0.88. The stock everyone thinks is dangerous and expensive is actually deeply undervalued. The PEG ratio forces every single sector to defend its valuation based on pure, undeniable velocity.
Let's get to work. Section 4, the acceleration audit, your cognitive task. All right, we're moving from financial theory to elite execution right now. This is your mandatory cognitive task for today's masterclass. We don't just learn concepts here, right? We weaponize them. If you want to master the cycle, you need to audit your current holdings today. I want you to open your trackers right now. Step 1, select the top 3 growth stocks you currently own or the ones you're aggressively watching. Step 2, open up their financial metrics and pinpoint their current PE ratio. Step 3, divide that PE by their average 3-year EPS growth rate. Calculate the metric yourself.
Yeah, and if you can't find a trailing or forward peg listed easily, just do the math manually. It's time to stop trading numbers in a vacuum. You have to force yourself to see the actual underlying velocity, not just the static surface-level price tag.
So we're going to leave you with this final provocative challenge. Are your investments truly supported by genuine explosive earnings acceleration? Or are you paying premium prices for a stagnating corporate machine that is destined for multiple contraction?
That's the ultimate test for any growth stock predator. Filter by growth velocity. Calibrate the Lynch model to your sector audits. Apply the architect's grid ruthlessly. Understand the math, master the PEG ratio, and go out there and rule the cycle. We'll see you back here tomorrow for day 118. Keep your edge sharp.